Welcome to the podcast about venture capital, where investors and founders alike can learn how VCs make decisions and reach conviction. Your host is Nick Moran, and this is the Full Ratchet.
Welcome back to TFR for another edition of Investor Stories. On this segment, the experts talk about a startup that failed and the causes of that failure. Here's the segment called Post-Mortems.
On this special segment, we have Cameron Borumand of Fuse VC. Cameron, can you tell us a story about a portfolio company that failed and why it failed?
A company that we invested in our previous time, it was in like the MuleSoft data connecting, application connecting category, application sharing. And they picked the right market because you started to see Zapier and MuleSoft and big companies getting built at this time, but the product didn't have clarity. And because the product didn't have clarity in terms of the types of use cases that were really a good fit, it was just too broad and too general to where the customer didn't get a sense of like how they could use it. And the product was also, it wasn't easy to use. And so the product messaging lacked clarity. And then even once people got within it, struggled a bit to use it and get it deployed. And so again, back to the storytelling piece I was talking about earlier, being able to tell that crisp, clear story transcends the entire organization, whether it's to your customers, whether it's to your employees, or even how your product is being built.
How do you handle a situation where you're looking at, let's say, a pre-seed startup and the use cases haven't yet been defined, pretty open-ended at that stage?
We work with the founders to, even pre-investment, just to have a brainstorm, and productive brainstorm. And you can get the sense pretty quickly if they're thinking, oh, it's going to, we're going to take it into healthcare, for example, and crush it in this. And then we're going to go, into financial services. And then we're going to go into, it starts to get very broad, very fast. We might start to think, hey, maybe that focus isn't there early on. And so it's just working with the founders to identify what are you going to be focused on and world-class at very early, focus on providing that time to value to customers very quickly and expand from there rather than trying to do too much and boil the ocean.
On today's special segment, we have Ryan Falvey of Financial Ventures Studio. Ryan, tell us a story about a portfolio company that failed and why it failed.
I had a company invested in a previous fund called Remedy, and they were doing medical payments. And it would help. What they were helping you do is actually interesting. So if you go to a hospital and if you have insurance, your insurance company actually looks through the bills and like figures out if they should have done that and like will figure out they should have charged and all that kind of stuff. But if you have a high deductible health care plan, or God forbid you're paying cash, there's no one to do that. And so these bills have all sorts of errors and inaccuracies on it. And so what Remedy would do is they'd actually scan your bills for you and then go back to the provider and dispute on your behalf and tell you how to do that. So sorry, a medical billing company. I said a medical payment company. They would just focus on the billing piece of it. And it's kind of tough going. And then they found these basically like self-insured plans. So like a big company might insure their own employees because it's a broad enough pool of diverse incidents and stuff, they can get away with it. And so Remedy was going to go and do that for these businesses. And they started to get some real traction. And then a medical billing company, a very large one, has a near monopoly over medical billing in this country, changed their policies to start charging $25 per inquiry for an agent of somebody who wasn't the patient. Overnight, just wiped out the business model. And, started demanding.
That sounds illegal.
Yeah. There's a reason healthcare is so kind of effed up in this country. And it was one of those things where you're just like, wow, didn't see that one coming. And it was really sad. I mean, the founder's gone on to be really successful. He's a great investor at Jackson Square Ventures now. We learned a lot from it, but it's one of those things where it was just like, what could you do? You're just up against the machine.
Brutal. Was that B2B2C? The model?
That was a B2B2C business. You're right. I'm like, see, told you. That's good
you
one.
Your lesson.
Touché. Yeah. Just because you don't like it doesn't mean you don't do it, It's one of those things. We all have our weaknesses.
On today's special segment, we have Steve Sarracino of Activant Capital. Steve, tell us a story about a portfolio company that failed and why it failed.
So this was in my early investing days. We invested in a company and it relied heavily on Google for its leads, and it was paid search. This was a long time ago. They had a differentiated approach. They had great algorithms before like algorithms were a thing. It was producing a lot of cash. So I think we were generating like 30, 40 million of annualized cash flow. It was growing really fast. We invested in it. It got announced. Google saw it and shut down our IP address. And so the company went from generating like 30, 40 million of EBITDA to like 2. We had to split the business apart into 3 different units, rebuild it from the ground up. We ended up eventually getting our money out, but it was a single risk. And this is why I have a hard time with those single risks. If we had just not announced it, we probably would have done fine. Eventually, Google changes their algorithm, so we would have been hit eventually. But, I just think there were good people around it.
Was it a threat to Google? Is that why they...
No, it wasn't a threat to Google. There really are no threats to Google. There's always another bidder for those AdWords. It was just, they don't want people, appearing to have an advantage on their system because we just had better data and algorithms effectively. So, it's like you look at a company for a long time, and this is back in the days when I cared a lot about business model margins and profits. Now it's like later in my career, go back to just like the team and the founder and the culture. If they're adaptable, they're going to get through it. And luckily, this team was adaptable enough that we got our money out, but it was not a successful investment. It's actually terrifying.
Steve, I'd love your quick opinion. We talked about e-commerce a bit, and you've got players that have, channel exposure, like the text-based marketing companies, Attentive and PostScript, et cetera, that they're pretty exposed to Shopify, right? Shopify is their growth engine, but they could be shut off at any time, or Shopify could integrate it in-house and develop it. How do you think about that as a single source of risk and, companies like that in the e-commerce space?
Yeah, it's a tough one. I think it depends where you sit in the e-commerce stack. If you're relying on like a Shopify or a Salesforce or SAP or Magento, Shopify in particular, they've got the biggest and most powerful network. If it was like 80% exposure to Shopify, unless it was something we felt like, eventually when they make that build buy decision, they'd have to buy, it'd be a hard thing for us to invest in. And maybe that's just my own scar tissue, and every situation is different, but those being reliant on a single platform it's hard these days because it's in that platform's interest to, bring that in-house. And in many ways that experience is better for their customers, right? Because then you're like a one-stop shop, which effectively is what Amazon's done. So that would be a difficult risk for us to take.
That will conclude this installment of Investor Stories. If you're enjoying the program and would like to see it continue, take a moment and leave a 5-star review in iTunes. Also, if you'd like updates on new content from TFR, as well as the top 10 VC articles every week, go to fullratchet.net and sign up for the newsletter. Okay, that will wrap things up for today. Until next time, over-prepare, choose carefully, and invest confidently. Thanks for joining me.